Do you know that it is possible to lose your money in mutual fund? Yes, I said so. It is very possible to lose money in mutual fund. A lot of people don't understand this, and the reason is because they fail to understand the different types of mutual funds that we have. Stay with me, because in this video I'm going to be explaining to you the different types of mutual funds we have, their associated risk, and explaining whether it is good for you to invest in 2026. Please stay with me. First and foremost, let's quickly understand what mutual fund is all about. When you talk of mutual fund, is a situation where investors actually bring their money together, and these monies are given to a group of investors, say the bank or the financial institution, or if you like, call them asset managers. What do they do with this money? That's where the difference is coming. These asset managers or these banks carry this money and help you or help the group of investors to invest this money in different classes of assets, in which the return from the asset is now divided and probably given to the group of the investors who have actually given them money to invest. Now let's look at the types of money, the mutual fund that we have. The first type of mutual fund, starting from the safest, is the money market. When you talk of the money market, it's more like a short-term security, such as the treasury bill. Now, the treasury bill actually offers a return that is ranging from, say, 15% to 23% or so. Early part of this year, I think it was around 23 to 24%, but currently treasury bill actually ranges between, I think, 15% up to 18%, depending on the tenor you are actually investing or the tenor you're choosing. Now, there are different kinds of tenors in treasury bill. The first tenor is 90 days. You can decide to invest in 90 days. You can also decide to invest in 181 days, and then or invest in 364 days. These are the three types of tenor that we have. And you have the primary market and the secondary market. I've made a video explaining the difference between the secondary market and the primary market. All right. So if you have not seen the video, please check the video out. Now, the treasury bill offers a return, and your return is given to you upfront. What do I mean by upfront? When you invest, say, 200,000 and the return is 10%, meaning 20,000 is supposed to be given to you as your return. How do you get this 20,000? The 20,000 is given to you now. It means the amount they are taking from your account is the net amount. So they will debit 180 into your account. And then meaning that the interest, which is the 20,000, has been given to you upfront. And then when the maturity comes, you're going to be getting 200,000, which is the principal. All right. So this offers a very low risk, and this also offers a very low return. So the second type of mutual fund investment is the equity mutual fund. When you talk of the equity, equity simply gives you the opportunity to be a part owner of a business. What does that mean? If you become a part owner of the business, it means that you are actually liable to anything that is happening in that company. If the company is going to be liquidating today, it means that you become a residual owner of the business, meaning that the debt holders in the business will have to get settled first before anything comes to you as the equity investor. So meaning that when you invest in equity in any business, it means that the risk is actually higher than somebody who is investing in the likes of treasury bill. All right. So if the risk is higher, of course, it's expected that the return will be higher. So the equity actually offers as much as 28 to 30 to 40%, depending on how well that business or that stock is doing. And there are two types of this equity. The first one is what we call the stock. All right. So the banks may decide to invest your money in stock, and you know how stocks behave. They are volatile. Your return is coming from two angles. The first return is the appreciation of the capital. If you buy a stock for 20,000 and then the stock, when you're selling it, it becomes 30, it means there's capital appreciation of 10,000 naira, right? So now, on the other hand, the second thing you can get is the dividend on the stock, which is something that you get every time. That's like the holding period. Within the time you're holding this investment, it is possible that the company gives you dividend, and that dividend becomes more like additional profit to the capital gain that you're getting. Now, here is the problem with this. When you invest in stock, it is possible that the price of the stock will reduce from how much you bought it. Say you bought a stock for 30 naira, and when maybe 2-3 years later, the value of the stock becomes 1 naira. What it simply means is that when you are exiting that market, you are exiting at a loss. So meaning that you can actually lose your money in mutual fund if the money is actually used to buy stock, which is like the equity. All right.